America would default for the first time in history. The full faith and credit of the United States would be impaired, and our country would likely face a financial crisis and economic recession as a result. We must address this issue to honor commitments made by this and prior Congresses, including those made to address the health and economic impact of the pandemic.
Inflation is elevated and will likely remain so in coming months before moderating. As the economy continues to reopen, we are seeing upward pressure on prices, particularly due to supply bottlenecks in some sectors. Mr. Chair, if I may just offer one thing. What I said last week was that we had all but met the test for tapering. I made it clear that we are, in my view, a long way from meeting the test for maximum employment.
That for the next 5 years, a Republican majority at the Federal Reserve with a Republican chair who has regularly voted to deregulate Wall Street won't drive this economy over a financial cliff again. And with so many qualified candidates for this job, I just don't think that's a risk worth taking. I know that some argue that your deregulatory actions are mostly harmless. I disagree. I think they've put taxpayers at risk for hundreds of billions of dollars. But even at that, so far you've been lucky. But the 2008 crash shows what happens when the luck runs out. The seeds of the 2008 crash were planted years in advance by major regulators like the Federal Reserve that refused to rein in big banks. I came to Washington after the 2008 crash to make sure that nothing like that would ever happen again. Your record gives me grave concern. Over and over, you have acted to make our banking system less safe, and that makes you a dangerous man to head up the Fed, and it's why I will oppose your renomination.
Right now we're buying $120 billion worth of securities every month, and all of those purchases add to accommodation. They're increasing accommodation. And we had set a test for beginning to taper those purchases of substantial further progress towards our statutory goals. We haven't met that yet, but as I mentioned, I think we've all but met it on the path that we're looking at. We would continue to add accommodation, not subtract it, until well into the middle of next year.
And it seems to me now we're seeing a broader, more troubling kind of inflation. Input prices are soaring across the board: raw materials, electrical components, energy, and consumer expectations seem to have internalized this. The New York Fed's most recent survey shows that they expect 5.2% inflation over the coming year.
Yes, I think it's fair to say that it is. Mainly what we've seen is that the supply side restrictions that are so much at the heart of the inflation we're seeing have not only not gotten better, they've actually, in some cases, gotten worse. Look at the car companies. Look at the ships dock, or with their anchors down outside of Los Angeles. And this is really a mismatch between demand and supply, and we need those supply blockages to alleviate, to abate, before inflation can come down. We do believe that it will, but however, if you look at measured inflation and what's contributing to it, most of it is still from a very small category of items.
Central bank digital currency could provide to the U.S. To name a few, instant zero-cost payments, interoperability and programmability with smart contracts, international competitiveness all come to mind.
I'd be glad to. And by the way, I agree. This is critical work that we want to take forward. So the laws that were, the relevant parts of our law were written long before digital finance was a thing. And a central bank digital currency could take many forms, it is possible that under some forms you'd be able to make an argument that it would be authorized under current law. But I think this is such a fundamental issue. It would be ideal if this were to be a product of broad consultation and ultimately authorizing legislation from Congress.
That is absolutely correct. It has nothing to do with future programs of payments. It is entirely about paying bills that have already been incurred by this Congress and previous Congresses. And it's about making good on past commitments, as you said, paying our credit card bill. I don't believe there's anything at all faulty about the math. I think there's no question but that if Congress were to fail to raise the debt limit, or even if it was feared, if we're getting close, and it looks, as in 2011, like Congress might not raise the debt ceiling and we might not be able to pay our bills, that you would expect to see an interest rate spike. And if the debt ceiling were not raised, I think there would be a financial crisis and a calamity. And absolutely, it's true that the interest payments on the government debt would increase. I would be concerned that the dollar and Treasury assets, which are regarded as the most secure in the world and serve as the basis for the dollar to be the reserve currency, that it would undermine confidence in the dollar as a reserve currency. And the interest payments of ordinary Americans on their mortgages and on their cars and on their credit cards would all go up in line with higher Treasury borrowing costs. Well, certainly it would undermine confidence in our government and in the role of the dollar and the safety of the dollar, which has really never been questioned. The dollar is the safe haven asset when times are turbulent that people feel is absolutely secure. I think China has a long ways to go in reforming its financial markets before the renminbi is a serious rival to the dollar as a reserve currency. But I can't think of anything more harmful to the role of the dollar than failing to raise the debt ceiling, probably closer to 4%.
Okay.
And that's already almost must be the case based on what's happened this year. One, in thinking about what is a reasonable level of debt, there are a number of different metrics that one might look at. Commonly, debt to GDP ratios are a measure that's widely used. Ours is a little bit over 100%, which traditionally has been regarded as high.
Our need to sustain the public's trust is the essence of our work. We want them to public to understand that we're working for all Americans, so we don't like to be having these concerns raised. It's really something that's very, very concerning. So as soon as I learned of it, I directed our staff to undertake a review of our practices. We've had in place a set of practices around investments and trading and disclosure that seems to have worked for a long time, only it's clearly, it's really not working now. And we understand now that we need to modify our practices, and we're in the process of creating ideas and recommendations for that. That's one thing that we're doing.